Yeah, let's quickly look at a debtor and a creditor in this class. We want to see who a debtor is and, of course, who a creditor is. A debtor is a person, it can be a corporate bodies as the case may be, a government, owners of organization. It can be anyone, okay? Yes. But the main definition of a debtor is described as someone or some group of persons who have not recognized payments for goods or services rendered or goods collected. A debtor is someone who is owing. A debtor is someone who is still in debt. Yes, they are described as debtors. A debtor is a person, a government, can be a government, can be corporate organization, can be companies, can be individuals. The distinctive features about a debtor is that they are entities that have accepted item from another entity and has not made payment. That is why they are described as a debtor or debtors. When someone when someone receives without paying, such a person is a debtor. For instance, we have A, we have B. If A accepts from B in transaction form and A has not paid B for the item received, A is going to be described as a debtor to B. On that note, we say that A has not yet paid what he or she collected from B. So we call A debtor to B. Now we have some features about a debtor. A debtor is recorded in the balance sheet, yes. We record a debtor in the balance sheet because in balance sheet, we describe the balance sheet as a financial statement that shows all assets and liabilities. Yes, in accounting information. Most times we do not call a balance sheet an account. It's a financial statement that actually wants to explain the liquidity and profitability state of a business organization. So a debtor is recognized in a balance sheet. Yes, a debtor is seen as a current asset in a balance sheet. Yes, a debtor is a customer. Yeah, a debtor can also be recognized as a bad debt. It is from debtors analysis that we experience bad debt, knowing that bad debts are irrecoverable debts. So in all of this put together, you should be able to understand what debtor portfolio is all about. So if you know how you can manage your debtor, know who you are granting debt to, okay? Know who you are granting credit facilities to, so that your debtor portfolio or your debtor risk can be reduced. That is what debtors are all about. Yes. Now let's quickly look at a creditor. Now the opposite of a debtor is a creditor. A creditor also can be a person, can be a corporate body, it can be an entity, it can even be a government. Yeah, a creditor is another person who has given out an item, okay, who has released an item to another person and has not collected payment. Yes, a creditor is an individual or individuals or group of bodies who have given out items and have not received payment. Such an individual is called a creditor. In our previous scenario, we painted between A and B, where A received from B, okay? And we call A debtor because it has not made payment to B. But here the reverse is the case. B has given to A, okay, on credit and expecting monies to be paid to B, okay? Yes, it is B now that gave to A in expectant of a fund or return, okay? So in this context, In this scenario, we are going to call B a creditor, okay, for an item released but has not actually received payment. So that is a creditor. A creditor is someone who gives out an item with intention or expecting that payment be made in subsequent periods. Do you understand? Now, we call a creditor a liability in the balance sheet. Yes, a creditor is a liability in the balance sheet. A creditor is found in the balance sheet. Both of these information, debtor, creditor, their similarities is that they are found in balance sheet. Okay. Another similarities about them, another features about a creditor is that uh, is also a customer. It's a supplier of goods. Yes. Okay. In return or expectancy of funds. Yes. It is found in the balance sheet and it is a liability. Yes. So we have been able to understand the difference between a debtor and a creditor. Yeah. Thanks for watching.